Hi everyone. If you're watching this video, I'm assuming that you're fairly new to the world of Forex trading and you're looking for a kickstart into becoming a consistently profitable trader. If so, you have stumbled across the right video. And you've most likely already seen through online or from others that there's a lot of strategies and analysis methods that you can learn, which can definitely be very confusing to the newer traders out there. But today, I'm going to show you three very simple and easy to understand concepts to learn and to combine to help you mark out high probability trade setups. Of course, as a quick disclaimer, I'm not saying that this will be the holy grail, as there is so much more that you should learn about the Forex world, but this will definitely help you read the markets easier from a technical analysis standpoint. So we'll jump straight into it. The way I'm going to structure this video is so I'll briefly explain each of the three different concepts, combining them together, and then I'll show you a live market chart example. So concept number one, order blocks. So an order block is by definition the last bullish or bearish candle before a strong move, also known as, say, a displacement in the opposite direction. The theory is that it indicates where institutions and large players place significant buy or sell orders. And you've got two different types of order blocks. You've got a bullish order block, which is the last down candle before a strong bullish move, and you have a bearish order block, which is the last up candle before a strong bearish move. So let me show you guys a quick example of what a bullish order block can look like. So say this candle is a bearish candle, and then the following candle is a large bullish candle towards the upside. So that means this area in price, so this previous bearish candle, is now our order block area. So let's just write order block. And what you'd expect price to do is you'd expect price to trade back down into this order block and then continue trading towards the upside. Simple as that. And now for argument's sake, let me also show you guys what a bearish order block looks like. So now let's assume this candle is a bullish candle now, and then the following candle is a large bearish candle towards the downside. And now this candle becomes, as a result, a bearish order block. And now our expectation is that we expect price to trade back up into this bearish order block and then continue trading towards the downside. Simple. Again, this is just a very simple demonstration and example of what a order block is. If you guys want to know more about order blocks, I do have a dedicated video made about order blocks on my YouTube channel. If not, I'm sure there's a ton of information already on the internet which you can just search. Moving on, concept number two, the Fibonacci retracement. So I'll just call it Fib here. A Fibonacci retracement, it's a classic technical analysis tool that aligns perfectly with smart money concepts. It works by dividing a price leg into key percentage levels, and traders can identify premium versus discount zones, optimal trade entry areas, and they can also use the Fibonacci to help them refine entries around confluences such as order blocks and other confluences such as fair value gaps or breaker blocks. Anyways, so of course for all of my chart analysis, I use TradingView, and on TradingView they have a Fibonacci retracement tool already integrated into it. And if you guys use other platforms such as MetaTrader for your technical analysis, they also have the Fibonacci retracement tools integrated within their platforms. So the main percentage that we want to focus on for the purpose of this video is the golden Fibonacci ratio of 61.8%. So there's a lot of reasoning why the 61.8% is classified as our golden Fibonacci ratio. I'm not going to be explaining that here in this video, but again, like I've already previously mentioned, in regards to order blocks, if you want to know more about the Fibonacci retracement, I do have a dedicated video already about this on my YouTube channel. If not, there's a ton of research and information about this online. So the way the Fibonacci retracement works is, if I give you guys a quick real life example, say you're buying stock, say you're buying Tesla stock. People or yourself, you'd want to buy the Tesla stock when it's at a discounted price. Buy the dip and sell when price goes up. That's the theory behind the Fibonacci retracement tool. So you want to buy it when price is in a discount area, so a retracement area. And in this case, we're looking for price to retrace roughly into the 61.8% Fibonacci retracement. So say we have a bullish leg within the market, all right? So we mark our Fibonacci from the low to the high of that bullish leg, and then we'd expect price to come trade down into the Fibonacci golden ratio of 61.8% and then continue trading towards the upside. And then the same goes on the flip side for a bearish market as well. And that's the Fibonacci retracement. Again, very, very simple. Now, the third and final concept is quarter price levels. So what quarter price levels are? These are levels which are psychologically significant and frequently respected by price due to institutional algorithms being programmed around these clean levels. So it's assumed that institutions often place large pending orders near these levels, which retail traders use them for stops, creating liquidity pools, and price tends to react to these levels, especially when aligned with structure, order blocks, or fair value gaps. And quarter price levels, when it comes to the Forex market, is every 25 pip increment. So I don't bother drawing these out manually on my chart. On TradingView, you've got this indicator called quarter price levels. And if I toggle it on, it automatically adds a horizontal line at every 25 pip price increments. If you'd like to add this indicator to your TradingView charts as well, simply head over to indicators and search for this one, quarter, theory, and whole numbers by the author called Rain536. And then the theory behind this one is, again, I've already mentioned, these act as key price levels or invisible and hidden supply and demand areas. So you'll notice on a lot of the Forex pairs, if not all of them, at every quarter level, you notice that price reacts from these levels as a supply and demand area. So in this example, so say we're now going bullish, we go down to this quarter level, react from it, go up again and react, and then continue trading. It's simple as that. So now let's combine all these three concepts together in a quick example, so you know how to use it as a potential trading strategy. Again, quick disclaimer, please use this video only for educational purposes only. And yeah, so we've got, say this is the current market condition which we're in on the charts, and we've got a order block. Say our order block is about here. We got an order block. I'll just put OB here. All right. And then price has come into this order block. All right, this order block, which is in line with a quarter price level, which is dictated by this horizontal line. of 1.355. And then this order block and quarter price level is also in line, let's say, assuming, oh, it's perfectly already there. The 61.8% Fibonacci level, the golden ratio. So those are three confluences which we can tick off. It's our now trading strategy. And that's where we can place a long entry. So at the quarter price level, where we have a order block in line with the Fibonacci percentage ratio, and we go long. We keep our stops, say at the previous low or below the order block, and we place our take profit at whatever next level of bullish liquidity there is, whether that's equal highs, imbalance in fair value gap, or another order block or a previous high or whatever it is. And combining those three things together really help traders, well, especially if you're beginners, form clean, high probability trade setups, helping you trade with the market bias and cutting out all of the noise when you focus on these three concepts initially within the Forex market. And yeah, so let's move on. Let me show you guys a live chart example. So here on the screen right now is the 1 hour chart for GBP USD. So of course I've already got it here in replay mode. This is the price action from last week. And we'll use this bullish leg as a example for the purpose of this video. So what I want you guys to do first is see if you can mark out those three concepts on this bullish leg. So pause the video and just do a quick mental breakdown of this chart and see if you can spot those three concepts which we just spoke about. And yeah, so I hope you have paused the video. If not, welcome back. Welcome back. So I'm hoping you were able to mark out those three different concepts which we just spoke about. So let's first mark out a order block. So here we've got a bullish order block sitting here, which has not been tapped into. So it's the area of price imbalance. So let's mark that out. So we got a bearish candle, and then the following candle was a bullish candle trading to the upside. And that left behind a bullish order block. Right. Let's extend that out. And now let's also add on our Fibonacci retracement tool. So again, marking from the previous high down to the previous low of this bullish leg. As we can see, this 1 hour order block is in line with our golden ratio of 61.8%. And now the third and final concept, which we spoke about, was the quarter price levels. So as you can see, this horizontal line is our quarter price level, just a pip above this 1 hour order block at 1.335. So we've got our three confluences ticked off, and this area in price is our point of interest for price to trade back down into to continue trading towards the upside. So let's assume we place a long entry precisely at the quarter level of 1.335, and we put our stops just below the 1 hour order block, as that's now our invalidation point, because if price was to come and then trade below the order block, this is now invalidated and our idea was wrong. And let's say our take profit is simply the previous high. So we're forecasting a 1 to 3 risk to return trade setup. So I'm just going to hit play and we'll see how this trade works out. All right, so price has traded towards the downside. We've tapped into this 1 hour order block. which is in line with the golden Fibonacci retracement level of 61.8%, in line with this quarter price level of 1.335. So let's see how this trade now pans out. All right, amazing. So as you can see in this live chart example from last week, as soon as price came back down into this quarter price level in line with our order block and Fibonacci retracement level, price continued trading towards the upside, continuing with this bullish bias. And setups like this happen every single week, at least once, across um, pretty much all of the Forex pairs. It's all about back testing and just seeing for yourself that when you combine these very simple smart money concepts, order blocks, Fibonacci, and quarter price levels, combining them together, they can really form really good high probability trade setups. And I'll pause the video here now. So if you found value in this, make sure to like, subscribe, and hit the bell icon so you never miss a video. If you have any questions, just drop them below in the comments. And also, if you're ready to level up your trading and you want personal guidance, check out the links below in the video description, and that will take you to my website. Other than that, thank you guys for watching. This is Aman from SMC Wolf FX. Trade smart, trade disciplined, and I'll see you all in the next video.